Good evening, and thank you for joining us. Tonight's webinar is a 42-unit case study. This is a property in Tucson, Arizona that Kyle and I bought in May with 25 passive investors. I'm Gary Lipsky, president of Break of Day Capital. Our other host is Kyle Mitchell, managing partner of Limitless Estates. Our companies work together and focus on acquiring multifamily real estate investments that offer value-add opportunities. We look in growing markets for undermanaged assets to maximize investor returns. Our goal each month is to bring you a ton of free content in these webinars. If there's something you'd love for us to present on, please let us know. And please post your questions in the Q&A. We'll try to answer them, all of them, by the end of the webinar. And without further ado, let's jump in. Kyle?
Perfect. Thanks, Gary. And welcome, everyone. Thanks for hopping on. And we'll hop right into it here. So first, I think it's important to tell you a little bit about myself and the journey that I went through before I found this property and before Gary and I were able to close on it. So that's where we'll start. And back in December 2017 is really when I first started looking into multifamily. Previous to that, I had been investing in real estate since 2013, mainly on single family homes, but both in California and out of state in the Midwest. So at that point, I started looking into ways to build my wealth faster. I wanted to scale, and single family homes just was not the way that I wanted to go after having some experience with it. So I found multifamily, and the first thing I did was sign up for a mentorship in a coaching program. I think it's really important to have that mentorship and that coach guide you along the way, especially in multifamily. Single family is something that you can do on your own, and you can learn as you go. But with multifamily, I think it's just got so many complexities to it that it's really important to get a mentor, to build a team, which we'll talk about in a little bit. And to have the team on your side and on the same page so you can accomplish your goals in multifamily. So I did that in 2017, and immediately after taking that course, and we did one-on-one coaching with Michael Blanc for about 7 or 8 months as well, I started building my investor list. So as you'll see, as we go through this, we closed on this property in May of 2019, and we started building our investor list in January of 2018. So that's 16 months of building an investor list before we were able to raise $1 million and close on a property. So a natural progression after getting coaching, I started going to meetups and seminars, and I started a meetup in Long Beach in April of 2018 to meet people in the industry and to get myself out there and to build my network up. So at that point, we identified Phoenix and Tucson, Arizona as our markets, and we've been looking out there ever since. So the process at that point was really to get to know the markets by driving out there, spending time with brokers, spending time with investors, and building our teams in the market. So we basically did that starting in June 2018 and still doing that today. So about 11 months after I found the multifamily industry, I left my full-time job to pursue this full-time. And I certainly wouldn't suggest this for everyone who has a full-time job looking to leave. I left prior to closing on our first multifamily deal. But this was something that I had planned on doing for a few years. I had set myself up financially, been saving up, and so we had a nest egg, and my wife and I felt comfortable that this was going to be my full-time job and something that we wanted to pursue. So I left my job in November of 2019. And at that point, we started 2 more meetups and a podcast. And at that point, it was about December when we found this property, end of December, beginning of January, when we found this property, and we were able to get it under contract and close on it in May. So it was definitely a long process, and we'll kind of take you along the way on how that went. All right, so this is how we found the property, and it almost literally happened like this, is that my wife and my fiance at the time, my wife now, and I both had our full-time jobs when we first started looking in Tucson. And what we would do is we would take 1 weekday off, because weekdays are important to get out to your markets. That's usually when the brokers are out there touring properties. It's tough to get tours on the weekends. So We would wake up at 2 a.m., drive out there at 2:30 in the morning, and arrive at 9 or 10 in the morning. And people ask me why we didn't fly. And at that point, we're trying to save a little bit of money. But at the same time, there's no direct flight to Tucson until that doesn't get in. It doesn't get in until about 1 p.m. So you would lose about half the day there. So we decided to drive. So we would arrive there at 9 or 10 a.m. and then we would set up broker tours all day long. So we meet with every broker that would meet with us. We would tour every property we could. We would meet with local investors, buy them coffee, buy them lunch, whatever we could. And then we would head back at 5 or 6 in the afternoon and get back at 1 a.m. the following day and then go to work the next day. So we did that for about 4 or 5 months. And then I was at the point where I left my full-time job. So I could do it a lot easier, but my wife was still doing it with me up until Gary and I decided to partner. So on one of those trips in January, we were driving in and we had made the calls to the brokers the previous week to see if they had any appointments. So we had appointments set up, and one of the brokers that we had an appointment with called me on our way out there and said, "Hey Kyle, change of plans. Do you want to see this listing that I just got today? I haven't walked the units yet. I just got the keys and the approval. Do you want to see it?" Obviously, I said yes, and he gave me the address, and we were the first investors to see the property. And lucky enough, our property management company was spending the whole day with us as well. So they met us on site, they walked the units with us, and we had about a 3-week head start until the property went to market. So even that day, we went out and we did some comps. We looked at all the comps around the area since we were out there. And it was like a 2 or 3 hour due diligence of this property before it was even to market or before anyone else got to see it. So we definitely got a head start out there. And you know, you need to do things that separate yourself from what other people are doing. And what we were doing was we were showing the brokers in the Phoenix and Tucson market that we were serious. We were driving out there. We're out there every month buying them lunch and getting face to face. And it just so happened this property fell on our lap. All right, so here's Townhouse East Apartments, and I think maybe 90% of the people that I showed this to at first were like, "Ooh, man, this thing's not very good looking. It's ugly," you know. And the first thing I would say is that we don't buy great looking assets. We buy opportunity, and there's certainly opportunity within this property that we'll get into a little bit more. But one of the first things you'll see on this slide is the Townhouse East sign on the corner there. And the first thing I did when I got to the property is I called that phone number, and that phone number was actually disconnected. Okay, so the only way people were able to lease up this property is by calling the property management company that was managing it and then asking if they had any available properties, and then that property management company telling them about some of the properties that they have under management. Because this property wasn't being marketed online, the phone number didn't work, and there is no on-site manager. So that's literally the only way that you can find this place. And so right off the bat, there's opportunity right there. It's just not being marketed. As you can see, the property is an old motel style property. And this in some markets would be scary, but in Tucson, this is a common type of building. And so these are not something that is a one-off. These are common in the Arizona and Tucson markets. And so we felt very comfortable after taking a look at it and taking a look at the competition. I'm going to use my mouse here so you guys can kind of see, but I'm going to point out something here. This is one of the other big opportunities here is these are sliding glass doors. And originally the broker's business plan was just to continue with the improvements that the current seller was doing, which is very light rehabs on the interiors, about $3,000 a door, and bump the rents $50. Well, sometimes you want to go with the broker's opinion on the business model, and sometimes you want to think outside the box. And while we were there, our property management company actually said, "You know what, why don't you change out these doors? It would give it a different look, and it would really add value to this property." We did some research. There was another property down the street that had done it, so we took some specs from theirs and decided to do that. Our property management company thought that we can not only get a $50 rent bump by doing that, but a $100 rent bump plus adding rubs. So that's just some of the things that we saw right off the bat. This property owner bought this property in 2008, and we purchased it for less than they did in 2018. She was not putting money back into the property. and she just was not managing it as you should have. So there was opportunity in that as well. I apologize. Sorry. Hold on one second. There we go. Okay.
It's funny, Kyle, you mentioned, when you showed people, the first time and they're like, not so sure. And that was my reaction too when I saw it. But at the end of the day, it's really not how I feel. It's about the numbers. And if the numbers make sense and there's a great business plan, then that's what it's about.
Yep, exactly. Absolutely. So this owner actually did not put any money back into the property until she was about to sell. At the point when she wanted to sell was in 2017. She had 6 down units at the time. The brokers told her, "Look, if you want to get anywhere near what you bought it for, you're going to have to put money back into the property." So they started getting all the down units up and then putting about $3,000 a unit. When we took a look at it, there was probably about 15 units completed. They planned on doing 18, and by the time we had taken over, they had actually done 28. So they had done an additional 10 units while the property was under contract, which is not typical of a seller when they're selling their property, especially for less than they purchased it for. So here's another picture of the property. As you can see, the paint's peeling off. Pool area is not too attractive. The railings are something that we had to address as well. These railings were not to code, so we had to redo these railings. All right, so these are what the interiors look like on the classic units. This is pre-renovation. And one thing Gary and I go back and forth on is I like the wood ceilings. He's not a big fan of those, but those are on all the top units. All the bottom units just have regular plain white ceilings. But as you can see, they're okay, but they're not great. They're very low income. There's people that have been living in here for 12 to 15 years, since 2002 and 3, that are paying $300 in rent. And market rent right now is $640 for a 1-bed and $520 or $540 for a studio. So well below market, and the man or the owner was just not doing a good job of pushing the rents or putting money back in the property. The other thing on this property too is the property management company is actually a single family home provider. So they're used to doing single family homes. And one of the big things about single family homes is that if a maintenance call, they're charging $30 to $40 an hour because it's not in-house maintenance, right? It's not in-house staff. So every time they had something wrong with the plumbing or something wrong with a door, someone couldn't get into the doors, or had a problem with the sliding glass doors, they're paying $30 to $40 an hour to go in there and fix it. For us now, we have a part-time maintenance person and we pay him $15 an hour. So there was tons of value add that we saw and potential in this property just by taking a look at the financials and listening to the story in the background of when it was purchased, what had occurred in the last 10 years, and where it was now. Okay, so these are the interiors. And again, they don't look awful, but they're just not upgraded, right? And they haven't been touched in a long time. The only thing they were doing when they would have a turnover is if the property had very bad carpet, they would just pull out the carpet and that's it. Wouldn't paint cabinets, wouldn't resurface the countertops, nothing. All right, so I've already gone over some of these, but the opportunity for us, when we walked it, we saw zero advertising. As I mentioned, single family home property management company, no rent increases for 16 years on some of the units. So this is a true value add. And when I say true value add, you'll see a lot of properties out there in the Arizona market that have been sold 2 or 3 times in the last 5 years. And each owner takes it over, adding more and more value. And at that point, there's just not enough meat left on the bone to get true value add. This property had not had rental increases in 16 years, had not had money put back into the property until it was about to be sold. So this is a real true value add. Surrounding properties, starting value add phase. What I mean by that is that there are 4 other properties in the immediate neighborhood that have just been purchased and turned over, and new investors are starting to put money back into those properties, which is a good sign, not only in the sense that their rents are going to increase and we can kind of control the neighborhood, but that neighborhood is going to start to get better tenants and residents in them. So as that happens, that submarket is going to begin to grow and get better occupancy and better tenants in there. So, in a growing submarket, this is walking distance to the #1 rated elementary school in all of Arizona, not just Tucson. Walking distance to Starbucks, walking distance to Whole Foods. There's a new development, 6-story mid-rise development going in with shops and retail and Class A apartments. And this property also had solar that was just installed. So the thing on the solar was the owner purchased or installed the solar in 2018, did not turn it on until February of 2019. So what that means is they weren't getting any electric savings until March. And so what we're able to do is now take advantage of all those savings going forward. But on the T12, their electric was higher, which or lowered their NOI, which then obviously we got a better purchase price because of that. We were able to use that to our advantage, but we're going to be able to take advantage of all the solar savings. All right, business plan. Gary, do you want to go over this?
Yep. All right. So this is so critical. Obviously, finding the apartment building without it really going to market is huge, because you have a great opportunity to get in early and not having to bid against so many people. And then really coming up with a good business plan with your property manager is so critical, because if you guys aren't on the same page, you're gonna hit some rough spots, starting off. So this is why it's so critical to put a lot of time into this. So obviously it needed interior upgrades. Each unit, I mean, we walked every single unit, and each unit is a little different. It's hard to find one, two that match. So some needed some flooring, some needed some refinished countertops, some needed some new appliances, obviously a new paint, new fixtures when they need it. So those are the interior upgrades. Obviously the doors, patio doors, some of them really didn't even lock well, and it's not really a good look to have those patio doors. So the new doors really added a nice look for anyone that's going by, and certainly anyone that's living there, really appreciates that upgrade. Storage units. So in the laundry room, there were these storage units that were basically empty, and there's some stuff that maintenance guy was using, but quite honestly, we do have a room for maintenance, so we were able to turn a bunch of these storage units into income, and that adds up quickly. If we rent 6 of these out for $200 a month times 12 months divided by let's say a 6% cap rate, you're talking about $40,000 extra that we've added as a value to this property. So that's huge, and it's just a quick little add-on. It's nothing that costs a lot of money. We added a barbecue area and a dog run, and we actually had to pivot on the dog run because of how the space that we had and the property line. So what we're doing is a dog pad. Certainly not as sexy, but it's still something for a dog owner to have that amenity. We fixed some of the landscaping. We had some really old shrubbery and whatnot. It was overgrown. So we definitely trimmed that out and gave it a much better look. And that cost was next to nothing. Fix some of the deferred maintenance. I'll get into some of those costs on the next slide. We increased rent to market and added rubs, other income. So for that's like late fees, collection of bad debt, pent rent, and any damage reimbursement. And they weren't collecting those things, which is crazy. But you'll see, when you're looking at properties that are owned by someone 5, 10, 15 years, the longer it goes out, the more things they aren't doing right, and that for Kyle and I means opportunity. Like he said, We added a great property management company. They also are managing our property that we're about to close on in Phoenix, 128 unit. Um, we also go through expenses all the time to make sure where can we save. Advertising, they weren't advertising at all. So we're doing some paid advertising. We're also doing some free stuff. We actually started using Zillow, which wasn't effective previously, and now we're getting a lot more interest in the property as well. So the more traffic we have, the higher the rents we can have, and also the lower the vacancy. And rebranding. So we have a new sign in front, obviously a new name. It went from Townhouse East. And when you look at that picture, I didn't see any townhouses, right? So Midtown on Second is a real nice, classy name, and it gets people a lot more interested in the property.
Yeah,
Let's
one
go to
thing
the
I want
next
to add
slide.
there, Gary, is when you mentioned the fixing the deferred maintenance, I think that's a big one that a lot of people are afraid of deferred maintenance. I like deferred maintenance if it's the right kind of deferred maintenance. And what we've been able to do is, or what our business plan always is that we want to go in and tackle the deferred maintenance on day one if we can. And the reason why is because all that deferred maintenance is causing day-to-day expenses. You know, things like the doors that we'll get into that had to be fixed on, you know, a weekly basis because people couldn't get in and they're paying $40 an hour for someone to come fix it, or some plumbing issues, things like that. If you can tackle those things right off the bat, that's going to lower your month to month and day to day expenses. And so, for an example, you know, we're budgeted at, I believe it's $500 a unit for repairs and maintenance, and the first thing we did is went and fixed the doors, and we fixed the boiler, and we fixed all the stuff that was deferred maintenance. And our expenses for the whole month of August for 42 units for R&M was $82, right? And I'm not saying that that's how it's going to be every month, but when you fix the items up front that are causing day in, day out expenses, you're going to lower your month to month expenses, increasing your NOI immediately. So that's where there's value add too. It's not just in putting money into the property, charging more rent. It's finding other areas where you can save money as well. And it's not necessarily, you know, pinching dollars and dimes. It's really finding out where the property is inefficient and fixing those items so that you can drive a higher NOI.
Yeah, that's a great point, Kyle. All right, so renovation budget you could see on the right. And when we're looking at a budget, we want to over budget, because there are some things that may come in more. You know, you start opening up walls, whatnot, there's going to be surprises. So you want to make sure you're fully covered. You don't want to go back to your investors and say, hey, we were short on our budget. So you really want to build in extra and get everything all up front, so that you can add extra stuff as well. Like right now, we didn't budget for a dog park, but we knew we had some really nice savings, and we were able to add an amenity. You know, so here you'll see the average rents, and obviously we're getting well, 540 on the studios now, and 640, I believe, on the one bedrooms. Railings, big savings there. We actually got lucky. We didn't have to replace all the railings. We got to retrofit it. So that came in at 16,000. So that's almost, you know, a $26,000 savings right there. Electrical upgrade too. We didn't have to do all the panels. We ended up just having to do the fuses. And sometimes you don't know this. You know, you have to budget for it, but things, you know, maybe have to do less once you close. So those are some nice gains that we had. The boiler actually ended up being $3,000 more. So that's a little give and take, but obviously we ended up coming in a lot lower than expected. Yeah, dog pad is I think it's gonna end up being like 1,500 to 2,000. So not much. Pool repairs ended up being just a little bit more. Yeah, that's it with the renovation budget.
Perfect. I'll go a little bit more into detail here on this stuff. Um, the expense ratio, as you can see on the T12, was 67%. Year one projected 60%. This is looking closer to being at 50% now because of those deferred maintenance items that we tackled on day one. And year two at 50%, we're hoping that can now go lower at 45%. So one thing I want to talk about is the business plan and how it's okay to pivot. We have a really good relationship with our broker and have been working with our broker really since day one on the business plan. And he was actually the one that pointed out the doors to us and some different things to do to the property, which actually helped us elevate the market rents. Initially, as you can see, the studio market rents now they're actually 540 and 645, like Gary mentioned. But originally, the business plan was that the studios were going to get 475 and the one bedrooms were going to get 575. But with the help of our property management company and broker, they helped guide us to a different type of business plan, which everyone else wasn't seeing, which allowed us to kind of get an advantage on this property. But my point on your relationship with the broker is we met our broker out there 2 months after we started our renovation. So he can see the property, and we talked to him about how is it best to reposition this property for sale. You don't want to just take over a property, add value, and then hope to sell it 5 years later without a business plan, right? So we want to always be understanding how's the market looking, what's the best way to position this asset for sale. And we actually pivoted a little bit on our business plan because of our discussion with our broker. He mentioned that there's definitely more value add investors and buyers in the market than turnkey. Our original business plan here was to fix up all 42 units at the same level of renovation, which essentially would not leave much meat on the bone for the next buyer, or that next buyer would have to test the market to something that was not proven already. So now our plan is actually adding a premium renovation, a premium upgrade, where it's very simple. We're going to add a backsplash, stainless steel appliances, add a dishwasher, and then add an accent wall. And we're going to try and get $50 on that. Now, we don't know if we can get that or not yet, but in January, we're going to launch our first unit, and we're going to see if we can get it. And the difference in price between the $3,300 we're spending right now per unit in upgrades, which is basically painting counters, adding knobs on the cabinets, new fixtures, flooring, and doing the countertops, resurfacing them, is about $3,300. The difference between that and what I said the premium upgrade is going to be is about $1,000. And so if you can get $50 per unit more for $1,000, your ROI on that is going to be 50%. It's going to cost $1,000. You're going to get $500 more in rent, $600 more. So it's 60% ROI. And the net on that, if we did 10 units, and we did that based on a 6.5 cap, you're talking about $100,000 in additional value as well for the property. So that's our business plan now, is we're going to leave 32 units for the next buyer to take these up to the premium level. But if we would have never invited our broker back to the property and said, hey, what do you think? What's the best way to position this? We would be moving on with our original business plan. And it looks like we're going to be able to get higher than market rents and also take those premium level rents up to more than we expected as well, with a great return. So this has been a really great story so far.
And that's where the team comes in. It's so important. Certainly, Kyle and I aren't experts in everything, and you just can't be. You need your broker. You need your property management company to rely on them to give their expertise, and you need them to push back if they don't necessarily agree with you, because you've got to keep throwing out ideas and keep tweaking your model to maximize the investment opportunity.
Yep. All right. So location, we've already really talked about this, but Tucson, Arizona, we're very bullish on the market. Number one in rent growth for tier 3 markets, job, wage, population growth, all on an upward trend above the national averages. Limited construction. So they're not building out there, and you can't build Class C apartments. So there's definitely a need for workforce housing, and that's what we provide. And that's why we love this asset class so much. I mentioned the growing submarket. Those are all things that they're located to. And, really within walking distance or a very short bike ride. So those are some of the reasons why we like this location. All right, so here's Midtown on Second now. So as Gary said, we rebranded it and we gave it a new name, and it is in Midtown. So this one makes a lot more sense. And we went with the advice of our property management company and our broker. So as you can see, brand new paint job, brand new doors here, new railings, so they look a lot cleaner. And here's a couple more angles. So the feedback from the residents so far has been fantastic. I think it definitely gives a new, trendier look. The yellow really pops so you can see it from the street, which is some of the reasons why we went with those colors.
So, we said it was about 30,000 for the paint and 16 for the railing. So you're talking 46,000, and then the name change. So just those, and the doors, just those, few things changed the property dramatically.
Yeah, the doors was the biggest risk on this property for sure. It was the highest item per unit that we did spend. It's $2,000 a unit, $84,000. But as you can see by the rents that we're getting above projected rents, it was worth doing it, and the numbers still work, right? And if I have a question here that says, what deferred maintenance items that are considered deal breakers for you? I don't know that there would be any deferred maintenance items that are deal breakers if the deal still works by replacing those items. So if the entire plumbing system need to be redone, or every single roof need to be redone, or you had to bulldoze the entire property and build ground up, if you're getting it for the right price and you're willing to take on the work that's provided with it, there's no deal that really we wouldn't do. It's just, do the numbers make sense? There are some things that you want to be wary of, like aluminum wiring, but there's ways around those types of things. And if you can get a credit, or if it still works with those numbers, there's really nothing that you want to shy away from, in my opinion.
Yeah, as long as the market makes sense, obviously, and we love Tucson and Phoenix because of the population growth, the job diversity, the job growth.
All right, so here's the interiors now, and as you can see, we've painted the cabinets, and we've actually decided to go with a different color. This was one that was previously done by the seller, minus the backsplash there. And for those of you looking at the backsplash, this is one of the things I love about real estate. You can be very creative, and so that's actually a sticker, and you can't even tell when you're standing in the kitchen. That costs us $30 for the entire kitchen, which is huge. And when you're paying rents as low as $500, $600, something like that can add value to it and really make it pop and be a deal closer for our leasing agent there. We've actually decided to pull those off of, well, not put them on any more of our standard upgrades, and we're going to save those for our premium upgrades now. But it's a really nice look, and I think it looks great. But we are going to go a white on white now. Like I mentioned, some of the units had already been renovated, and so this is one of them. But very light upgrades here. And, some of the appliances had to be upgraded. Some of them are okay, but on average, we're spending about $3,300 a unit. All right, challenges. So I think it's really important to go into some of the challenges that we faced alongside this property and as we close, because we're here to add value, right? As Gary said in the beginning. And so we wouldn't be adding value if we didn't tell you about all the challenges that we had. And so I'll go into the lender and the closing. This is something why building a team up front and having people who have experience with something like this is important. So at first, when we found this property, Lolita is my wife, felt that we could raise the $1 million that we needed to close this property. And so we said, okay, we're going to do it on our own. Our parents were going to sign on the loan for the net worth and liquidity, and everything was good. We were good to go. And our business plan at that point was, if in 3 or 4 weeks after starting to raise money, we had some challenges and we didn't feel like we were going to get there, that we would bring on another partner. And that partner was Gary. And the reason why you want to do that is because as a syndicator, we're raising $1 million for this property. If we can only raise $800,000, can we close on the property? Yes, but we can't fully execute our business plan. And that's the biggest thing as a syndicator, right? You have investors that are investing in this deal. You're telling them that you're going to execute this business plan and provide them X returns. Well, if you don't have the money to put back into the property, you can't execute your business plan, and therefore your business plan is now faulty, and you may not be able to get the rents that you're hoping for because you're not putting money back into the property. So about 3 or 4 weeks in, we really were not feeling great about the raise. And ultimately, we would have gotten there on our own, but I did not want to put our investors in a situation where we did not raise all the money and we were not able to execute on the business plan. So we went to the lender and we said, hey, we want to add a general partner, and he's going to help finish off the raise with us and help in asset management. And they told me no. They said it's too late. We've already submitted our paperwork to Freddie Mac, who's the government agency that that's lending on this property. And I had previously explained to them what our plan was, and they said, okay, just keep us updated. And then they switched on us. And if there's one thing, if you've ever dealt with a lender with multifamily, they control everything, right? They're loaning 70 to 80% of the loan. They're your biggest partner in the deal, and they really control the deal. Rates, loan terms, everything. So at that point, I was really stuck between a rock and a hard place because we do 506B offerings. And what that means is that we need to have a pre-existing relationship with these people. We can't just meet them or advertise for in order to get this money. And so we had to know these people. And so you can't know any more people once you start the offering. And so at that point, we decided to jump ship, find another lender about 29 days prior to close, which is a very short time frame to get a deal closed. It usually takes 30 to 45 days. We found a lender that said they can do it. We went Fannie Mae. We brought on another partner who could sign on the loan for us, and we were able to get it closed. But it was a very stressful 30 days, and we ended up getting a huge discount on the interest rate as well. So everything with that process ended up working out for the better. But at the same time, I really wouldn't want to put our investors in that situation again. Nor would I want to go through the stress myself. I think it's always best to just be as transparent as possible and have your team on the front end set up so that you can close on the property and not change your business plan halfway through when it comes to the lender. So a couple other things that we had challenges with, and these are all small things, but these are things that as a syndicator, as an apartment owner, you're going to have to deal with, and your real job is being a problem solver. And if you can solve problems, you're going to be great at it. So changing out the doors, we did not think about the blinds, and I'm actually going to go back here. As you can see, the windows on here are very large, and we did not anticipate this, but we purchased these doors because they fit perfectly in this section. We did not have to retrofit this, so they just popped right in. We got them from Home Depot, and we were pretty fortunate to find this because otherwise this would cost about $3,000 a door, which is definitely out of our budget. So the one thing we didn't realize is that the current blinds on there did not fit in here. And so now you can see directly into each of the residents' apartments. And so they were not very happy about that. We have fixed it since and purchased blinds that we hang on the interior, on top, on the inside. But it's definitely something you want to think about, is that when you're adding value to the property, you're doing it for the people who live there, right? Because they're the people who are paying you the rent. And the biggest expense that you incur when you're an apartment owner is turnover. When you have to take the tenant out, re-turn over the property, put money back into the unit, and then lease it up, that's all costing you money. Obviously the downtime when no one's paying rent in there. And so you want to have the least amount of turnover if possible with the most amount of rent growth. And so when we installed these doors, it was certainly a challenge, and we did not get good feedback at first from the residents. They now love it after we add the blinds. But when you're doing value add, you've always got to think about it from the position of who is living there. Are they going to like this? Does this add value to their life, not just your bottom line? All right, dog park easement. Gary mentioned that earlier, so I won't get into that. Weather delays in Phoenix and in Arizona as a whole. They do have a rainy season, which is during the summer. They have, I believe they're called, are they monsoons, Gary?
Yeah, I believe so.
Yeah. And so we did get the The paint had to be delayed for about a month, which isn't the worst thing, but definitely when you're adding value and you're raising rents, you want to get the exterior looking as nicely as possible. So that was one of the challenges. We did have a death on the property. I won't go too far into it, but we basically had to bring someone, the hazmat team in, and the unit had to be down for 3 weeks while it got cleaned up. And those are just things that you don't plan for. You know, it ended up costing us about $4,000 to get that done, and that was not budgeted for. And those are just things that are going to happen on the property. So we also had some challenges with access to Wi-Fi for the cameras. So now we're having to hard wire everything in. It's been about a 2-month delay. And so we actually had a little bit of vandalism on the property 2 weeks ago where we could have used those cameras, but instead we have been unable to. It was very mild vandalism, but nonetheless. And then delays on name change and branding. So one thing we've learned is that Arizona takes about a month to 6 weeks to change the name and to approve the name change. And so, you know, on our new property in Phoenix, we're actually already started that before we're even closing. So on day one, we can change the name. But that did take quite a while, and that's been done since now. All right, results so far. Go ahead, Gary.
Yeah, so Kyle mentioned the turnover being one of the biggest expenses. You know, we were really surprised that our turnover has been so low. So we've got tenants that were, you know, paying $400 a month that are actually staying and paying 50% more because they like what we're doing, they like where they live and all that. So we were really surprised that that cost was you know, much lower than we anticipated. Obviously, you saw the exterior renovations, and you know, in my opinion, it really transformed the property. We got into the pro forma rents. We're above them already, which is really exciting, which moves our business plan up potentially from a 5-year sale to potentially even selling it off in a year and a half. Rubs were getting 35 a unit and 90%, 98% occupied. So we're constantly monitoring. We have weekly calls with our property management company and discussing, okay, well, we've got 4 people on month-to-month rent. So, you know, how many do we want to tackle each month? So we don't want, you know, too many apartments available, and then it really brings down our income. That's not our business plan. Our business plan is to continually keep our occupancy up and turn units as they be, and that's been happening. So we're really excited that things have been, you know, certainly we've had some curveballs thrown at us, but that's, you know, the norm. And we've been this property has been far above expectations.
Awesome. All right. So the last thing on this deck that we want to share from you, is I talked about it earlier, is that it's really important to take into consideration the people that are living at the property. And we certainly learned from some challenges that we dealt with. When you're putting this money back into the property, you know, we had to go in and fix the fuses of the electrical. We had to change out the doors. We had to go back into their property to hang the blinds. We're redoing the painting. So we got to cover up their windows and their doors with, tape and paper and all that kind of stuff. And we had to redo the railings. And so there's a lot of work going on in this property over a 4 to 6 week period where people have to live day in and day out with that. Now, we did a monthly newsletter. We let everyone know what our plan was, and we did all that stuff in advance. We tried to communicate with everyone as much as possible in advance, but always remember that these people have lived here, some of them for 15, 20 years, and you're really doing it for those people. And so always take into consideration the effect it's having on them, the effect it will have once the property's upgraded. And so, like Gary said, we've been able to retain most of the residents, which was surprising to us, but also fantastic. But this is a letter from one of the residents, and I'm not going to read it word for word because I'm a horrible reader, but what this basically says is that in the beginning, when she learned about all the changes that we're going to make to Midtown, she was really upset. She had been living here for 15 years, and she just was not happy about it. And every day she kind of saw the value add that we were doing to the property, and we were communicating with her consistently. And at the end of it, she was really stunned by the results of the property. She loves the property. She loves that we have staff out there now who's answering their questions, who's fixing the property when they have any issues. You know, they used to call in and let the property management company know that, hey, their oven's down or their sink's backed up, and they wouldn't get to it for several months. And so, you know, we make sure that we're on top of it and we're getting to those service calls on a weekly basis. And so those are some of the things that happen after you close on a property that are extremely important. So this is just a letter thanking the painting company, actually, but in here they mentioned just the total renovation and how great they love it. So I thought this was a really good story. All right. What the heck is cost segregation? So this is our next webinar that we're going to have on October 28th. And this is a great one for both passive and active investors to get on, because cost segregation is definitely something that is a hot topic right now. Everybody's doing it. You also want to know how it's going to benefit you or some challenges that you may have with it. You know, a W-2 employee is going to be taxed differently on this than a real estate professional. And so those things are very important to take into consideration and understand from a business plan standpoint before you invest in a deal. So we're going to be talking with ELB Consulting, who's taken a look at our cost segregation for this property as well. And they're going to go into detail on what a cost segregation is and how it can benefit you. So we'll send the link out to everyone in the follow-up email that you'll receive tomorrow with this.
Yeah, cost segregation and bonus depreciation. I invested in a deal at the end of December, $100,000, and I got a $61,000 loss on my K1, which was fantastic because I was able to use it against some gains. And, you know, you're talking, you know, a 22,000 plus savings for an investment I made, you know, a few days before the end of the year. So I definitely recommend checking that out.
Perfect. All right. So Gary and I will open up for Q&A right now. So if you have any questions, please type them in the Q&A box. And then I do see some questions here in the chat box. So I'm going to go through here and read them and then answer them as we go. Let's see. What does the projected IRR for this deal look like? So what I'll tell you is that when we first purchased the deal and to our investors, it was a 7.5 cash on cash, about and a 13.5 IRR. As I mentioned, when we were dealing with the lender, we got an 80 basis point discount on the interest rate. So our interest rate originally was 5.01%. When we closed, it was 4.2 because it was at that time of the year where the interest rates just completely plummeted, which is fantastic to us. So those numbers are higher than that right now. I don't want to quote what they are projected at now, but that's what they were projected at when we were presenting it to the investors.
Any other questions? And just so you guys know, if some of you came in late or want to share it with someone, both of the webinars will be available on my YouTube channel, Break of Day Capital, and as well as Limitless Estates. You'll also see our other content there as well. So definitely check it out and connect with us on social media as well. We're on Facebook and LinkedIn, and we'd love to hear from you.
We do have a couple more questions. So let's see. Eric London says, oh no, I'm sorry. Alfred Chung, what is the best way to find a paid mentor? So, you know, I really think it depends on the person. I'll tell you what my opinion is. I think that mentorship is extremely important, but the thing mentors do is they push you out of your comfort zone, right? That's what you pay them for. You don't pay them to give you all the education, because I think every mentor is going to teach you the basics about multifamily, and they're all going to give you the same type of advice for that. What you need to find is someone who you can relate to, who's going to push you out of your comfort zone. So what I did is I interviewed about 5 or 6 different mentors. And the one I felt most comfortable with was Michael Blanc. And that's why I went with him, because the more comfortable you feel with your mentor, the easier it is for them to be able to push you out of your comfort zone. If you're joining a group because your friend says to join the group, but you're not really sure if you really fit with that group or you didn't exactly love what they said, they're going to have a tough time pushing you out of your comfort zone. And that is extremely important. So the best way to find a paid mentor is to interview 5 or 6 and go with the one that you feel comfortable with.
So we have another question here from Connor. Are you looking to refinance soon? So that is an option on the table, but most likely we may sell because, you know, time value of money on this business plan. If we refinance, you know, we're already within a year could be hitting our 5-year projection. So our investors are looking to potentially put that into another deal. So we'd probably do it that way instead of refinance. If we had a different business plan, then maybe we would refinance.
We have a question. Who is the best broker in the world? We're going to give a shout out to our broker in Tucson, James Crowley with Marcus and Millichap. He's the one that helped us find this deal. But I think he would say the same thing. It really was, you know, building a relationship first. And then, you know, from there, you build trust in one another that you can get the deal done. And that's when we sell the property. So shout out to him. Definitely. Let's see. Where do we host our meetups? Actually, so Gary and I both host several meetups, and we actually host one in Phoenix once a month that we fly out to, and that's the 4th Wednesday of every month in Scottsdale. I host another meetup here in Long Beach, California, and that's the 2nd Tuesday of the month. And Gary, when is yours?
So it's typically the 3rd Wednesday of every month, but this coming up month, we're actually having it on October 17th, the Thursday, just because of some spacing issues, and that's in the WeWork downtown.
Yeah, so you can find us just if you went to on meetup.com and found us at multifamilymasters.com. We're all on there, and we actually have about 50 different chapters nationwide, and we're part of the leadership group on that. And Gary and I run 3 of those chapters, and they're once a month. Let's see. What's your opinion of the Mesa market from a multifamily long-term hold standpoint? Gary, do you want to take that one or me?
Yeah, I mean, we like the Mesa market a lot. I mean, anywhere in Phoenix, and so for those of you that don't know, Mesa is part of the MSA, but outside of the city of Phoenix. It's a hot market, and so these are, you know, the population growth is phenomenal throughout Maricopa County. Obviously, it's one of the fastest growing counties in the United States. So for a long-term play, it's a great play, but what are you purchasing at? That's so key, you know, and that's why we're looking, you know, Colin and I typically want something that's got a little hair on it so we can add value, and that's going to protect our investors. But, you know, other institutional investors buy turnkey properties and, you know, don't put much money into it. And they achieve a much lower return, but we're trying to maximize our return. So it's finding that purchase price, and cap rates are compressed right now. So it's hard to find a good deal, but you got to have those broker relationships and continually be out there.
Yeah, I like the Mesa market. I mean, they've got the light rail that goes through there, and they've just got approved for Google just got approved for a $1 billion plant out there. There's a lot of things happening in Mesa, along with Phoenix as a whole. So I really do like Phoenix as a whole. So sorry for the late drop in. Are you using a property manager in Tucson? Yes, we use Shelton Residential, who we will also be using on our Phoenix property. We absolutely love them. And one of the things I actually didn't talk about during the webinar is that, you know, one of the things that we love about the property management company is the regionals that they hire. And they've done a really good job of that. And I think a lot of people, when they look at property management company, they don't drill down far enough to understand who is your regional going to be and how are their properties being run and how are their properties performing and how are they with hiring. And so we have fantastic regionals who have great properties, who've done a great job hiring, and that's one of the reasons why we love them. They're one of the largest property management companies in Phoenix and Tucson, but at the same time, we don't feel like just a number on a piece of paper. They're very personable. We have weekly calls with them. They're very responsive, and they're really great to work with. So we highly suggest them.
I guess that's it.
All right.
Well,
Well, go ahead, Gary.
yeah, I really appreciate you guys joining us tonight. I hope you got a lot of value. If you like our content, please share it. If you'd like to learn more about limitless estates or break of day capital and learn how you too can earn passive income while taking advantage of tax breaks, please reach out to us.
Thanks, everyone.